Earnings and economic data came in better and hotter than expected, and this left many of us scratching our heads trying to make sense of it all. But if there's one thing I've learned as a trader in 2023, it's that you need to adapt to an ever-changing market. But what happens when correlations get thrown out the window? Well, you need to dig a little bit deeper because there's a reason for everything. Today, we dig deeper. We talk about the S&P 500 and what restricting chip exports means for semiconductors. Yields are rising and the Fed keeps injecting. What does that mean for the market? And we also need to discuss oil and the president. Welcome everybody to the daily recap show where we talk about stocks, commodities, and cryptos. If you like this content, please subscribe, hit the notification bell, and let's get into it. It was a very choppy day across the market. Semiconductors led by NVDA saw some massive selling on China news. We saw some muted action in technology as a whole. Energy and basic materials led the way. That being said, stocks did see huge declines at the start of the session and par those gains towards the end of the session on the back of great retail sales and earnings coming in much better than expected. This is the earnings calendar and we have the big ones reporting next after the bell, I believe, Tesla and Netflix. Everything is going to be on margin growth for Tesla and subscriber acceleration for Netflix. This earnings season has been pretty good so far. The S&P 500 earnings surprise as a percentage for Q3 2023 is at 10.1%. This is the 5-year average, so we are seeing some pretty good earnings. 3 banks posted results before the market opened. Goldman Sachs, Bank of America, and Bank of New York Mellon all topped Wall Street's expectations. Johnson & Johnson's first earnings since spinning off Kenvue also beat forecasts. United Airlines and a couple of other airlines, they reported earnings too. They did pretty well, but the price of oil did squeeze their margins, particularly jet fuel. Jet fuel is extremely sensitive to the price of oil. Along with earnings, we also had some very, very hot data, and this has pushed GDP growth expectations up after retail sales outperformed. Gross domestic product projections are inching higher after the latest signs of a resilient consumer spending. The Atlanta Fed's GDP now ticked up 4.5% from the prior forecast of 5.1% growth. The strong growth in the economy means the Fed may need to be more aggressive in raising interest rates. So we just got hot data from retail sales, which means GDP is going higher. And because of hot economic data and great earnings so far, yields are moving higher, especially the 2-year. Such a sharp increase right here. Yesterday, we did see the 30-year, outperform the rest of the yields, but overall yields as a whole across the curve. Because of increased interest rates, we are seeing mortgage demand is the worst it's been in almost 30 years. And the only way that this is going to get back to these levels right here is if rates come down, because quite frankly, the issues in the housing market in the US are as such. People aren't selling their houses because they've locked in 3.5–4% interest rates, and that's having a huge issue on supply. It's keeping prices elevated, and that's seeing mortgage demand go lower because high interest rates, people can't afford a high house price with high interest rates. It's just simple supply and demand. So when are we expecting rate cuts? Now, this is the Fed fund rate futures, and we are expecting rate cuts to occur in this area right here as early as April and May 2024. But let's put it all together. And this is a graph from Fed, and it's the 10-year to 2-year spread. This right here is the spread. This right here is the Fed fund rate futures. This gray area is when recessions have occurred. When the yield curve inverts and then uninverts, okay, so an inverted yield curve is below this black line. When the yield curve inverts and then uninverts, we normally get a recession. What follows a recession? Falling rates. And this is where we are right now. The 10-year, 2-year spread is probably going to uninvert very, very soon. Yields are fairly high, which means we can expect rate cuts once we get that uninversion and the recession. So are we expecting a recession or a soft landing? Well, let's have a look at the stats. This is recession chances based on a small cap, large cap spread. And you can see here that when small caps underperform by more than 10 years, we normally had a 50% chance recession within 3 months, 50% within 6 months, 57% within 9 months, and 71% within 3 years. So long story short, where small caps have underperformed large caps, recessions normally occurred within this time period. So can we expect a recession? I would say that it's probably likely, but the consumer is really, really resilient based on the data we saw earlier. Be careful, guys. Just be mindful that this is just a statistic and the financial markets are far more complex than just looking at simple numbers like this. Now, guys, with recessions comes decreased margins, and with decreased margins, we normally get contractions in the stock markets. We get bear markets. Now, this is some stats here that when we've had bear markets, right, what we've returned the first year after that and what we've returned the second year after that. When the S&P 500 has had an average of 26.3 to 30% decline. The following year, we've actually had a 33 to 37% increase. And the year after that, compounded by the way, we've had a 13.5 to 14.5% increase in the stock market. This does sort of make sense because we are expecting 2024 earnings to be about 12%, a bit rosy in my opinion, but that's what analysts are expecting. An earnings season is going really well for the moment. We'll see what Tesla and Netflix bring to the table. Again, just a stat, use it at your discretion. Now, what can we expect for the rest of the year? Well, you can see here that when we've had a January to July, which has had a greater than 10% increase in the market, a negative August and September, generally we see a very positive Q4. In fact, from 12 times, we've seen an increase of at least 7.73% up to an average of 8.39%. And there have been some outliers right here, but we've seen a very positive Q4 when we've had a January to July that's been more than 10% and a negative August and September. Now, looking at the week specifically, you can see that October OPEX, in the 40 years, we've had 30 up weeks and 10 down weeks, returning on average 0.78%. So the current week we're in right now is actually a generally bullish week. Now we're going to talk about where I do believe the week is going to end. But just a statistic, this is a very bullish week, and 30 out of 10 times, that's more than 75% positivity. Another positive stats for the bulls right here, and this is a New York Stock Exchange margin debt and the growth of the index as a whole. And we can see here that when margin debt gets below this level right here and returns to a zero baseline, index normally just rallies. We can see this is the case right here, here, and here. And this is a huge data set since 1955, but this is more for a longer term investor. As you can see right here, this is 2010 to 2020, a 10-year period. Looking at some unusual options activity, we saw the usual culprits here. The S&P 500, SPY had some pretty high options activity, as well as NVDA. Obviously, just because of the news, they saw a huge amount of puts, but also pretty on the call side. Maybe some people saw some value, wanted to get some long calls right there. IWM saw some pretty large activity, huge amounts of puts stacked on this side right here, probably creating a put wall at the lows. McDonald's, three times 90-day average volume here, but overall, it was a fairly lackluster day for options volume. We had 34 million. Expect this to ramp up as we get to Friday OPEX. The average volume is nearly 40 million, and we saw 49% puts and 51% calls. Expect options volume to really ramp up into Friday, and expect to see these volumes go crazy through to the end of the week. Now let's get into some dark pool trades, guys, and this is something that we've been looking at for a while. So on my Friday video last week, I said this right here, I said it was buys, and that's exactly what we saw. And then in yesterday's video, I said that these were probably sells, and what did we get? We got sell side into here. And I actually did outline why I thought we would get that, because max pain is a 367. We're closer to the 370 mark. So max pain is sort of at this level right here. And what do you know? I said we would probably come down to max pain, and that's where we sort of are right now. And we did see some more trades, dark pool trades happening in this area right here. This is for the QQQ. And what is my take on this? I do think that we're probably going to I do think we're going to see upward action through to OPEX, and then we're going to see some pretty crazy action take place. But I expect the week to finish around this 367 level for the Qs. Moving on to the S&P 500 Trust, it was the exact same thing. We said there's going to be buyers in here, we rallied. We said sellers in here to max pain level, we fell. Now we did come back, we did rally intraday, but max pain is at 430, which is this area right here, and I do expect us to probably finish the week around this area right here. Again, did see some large dark pool trades happen in this area right here, guys. These are very big trades that are happening at these levels. So anything could happen, guys. We could just rally across these highs. We could fall all the way to 430. But generally speaking, max pain theory suggests that market makers want to move price to max pain to have the most amount of contracts expire worthless. And that's for the SPY at this 430 level. Now let's talk about the IWM, guys. We saw trades coming here. Again, you can go have a look at the Friday video, and we saw a huge rally up here. Now we did see some trades happening here. Max pain is at 177, this level right here. So, I do expect some bullish action to come into the Rust, but just be wary that, there's a lot of liquidity, big guys sitting here, and now also here. And I think these are probably buy trades, in my personal opinion. Thank you so much for watching, guys. Please like, comment, subscribe, share this video around if you like it. Toodle pip. So guys, thanks for watching my daily recap. I thought I'd throw these at the end of it. It's essentially just the trades I've taken or the open positions I've had for the day. I don't trade every day, maybe 2 to 3 times per week. But if you have a look here, these are the trades I currently have open. I do have the Australian 200 cash, the ASX 200, and then I have the US Russell 2000 cash. So I have these trades open right here. The Australia 200 were positions I took on the weekend. This is the daily chart. I had placed these triggered here, and I've held them ever since last Friday. The Russell 2000, I saw some pretty good volume come in on some dark pools, and I thought I'd front run that. There you go. We saw that volume was that volume was validated as we went up. I probably will close these very, very soon, but we'll see. I might just hold them. I might close half out. I did actually have another trade right here if we did go lower. As of right now, these are the 2 trades I have open. If you want to see more of these, more of my trades that are open that I do trade about 3 or 4 times a week, depending if I can see some good entries. I do day trade and overnight trades. Those are the 2 main things, but I divert all my profits into my long-term investing portfolio. I am a Warren Buffett mentee, I guess. He's sort of I love him and Bill Ackman. I like to base my approach on that. I'm very much I wouldn't say a value investor, but I'm a growth investor who knows how to value companies appropriately, and I really do hold for the long term. So if you guys want to see my overall portfolio, what's in it, as well as my trading strategies, let me know in the comments and I'll get that out to you as soon as possible.